You heard about this Fed meeting.
When?
Yeah, it's on Wednesday, 2 o'clock Eastern time, by the way. We'll get the decision. I mean, I got to ask you the most basic question. I'm sorry to even do it. 0.75% or 1%?
Oh, well.
Or more?
Here, they're not going for more. I think 0.75%, I think, is the most likely outcome. I heard somebody the other day make a comment about 50, and I'm like, there is no way you're doing 50 because of where we're pricing Fed funds futures. But on the other hand, we can't rule out a full 1% increase. So, I think 1% would be better than 0.75% because there's more hiking to come, and they might as well just get it behind them.
Well, that's it. It feels, and you talked about this at the Milken conference with us on camera. We did some events, which is, it's like the Fed's going 100 miles an hour in a car on a wet road, and there's a wreck up ahead. They got to slow down. Right. But it feels like they're trying to slow down sort of all at once, but too slow at the same time.
Right.
How does this end?
Well look, this is going to end in tears.
For who?
For investors.
Us on this show?
Yeah, well, people that are long risk assets.
Hasn't it already? I mean, this year's been awful.
Oh, well, it can get a lot worse. I mean, I commented a couple of weeks ago that I thought we had another 20% to the downside in stocks by October. But, Brian, when you look at the stuff that policymakers should look at, the money supply is contracting. We have inflation that we're looking at in the rearview mirror. We're not looking at inflation going forward. There's a very good chance that in the attempt to prove their credibility that they're going to overdo it. And I think at some point here, as I said back in April, they're going to push it until something breaks. And I think the break will probably come through, equity prices, but could come in another place. It could come in the emerging markets. So, eventually this will end in tears. And one thing, people that are talking about a stock market bottom, I would just point out one thing, and that is we have never had a bottom in a stock market without the Fed, while the Fed is still raising rates.
Never. Never had a bottom in the market while the Fed is still raising rates.
That's right.
So the question is, how much longer do they raise? I mean, is it now in November and that's it?
Well, my personal
then you could make the case for the market bottoming in December and then kicking off and something in next year.
Well, look, I think the latter part of the fourth quarter could be a very good time to get in. I think the Fed into equities. I think that my view was that we're going to go 3 quarters at this meeting, a half a point at the next meeting, and a quarter at the December meeting. And that would be the end of it. But again, the Fed isn't necessarily thinking of this the same way I am, and they're certainly not focused on the money supply numbers. The money supply numbers are really disturbing.
I know. Listen, don't be you talk to the Fed. I know you talk to Federal Reserve officials, both retired and current, and we get that. So there's your view. Maybe we get a little frosting, a quarter point in December, and you were on the record as saying that could be a good time to get into stocks. I want to unpack what you just said about the money supply. We get a little interest rate obsessive here on CNBC. I get that.
Right.
We need to talk more about money supply, M2, M6, because if I overlaid a chart of money supply versus the equity markets, they look like twins.
That's right. It's a high correlation.
So if one's going down,
right,
maybe that's why we're down 15, 20% on the S&P this year.
Exactly. And it's going to continue to go down. Shrinking the balance sheet, raising rates, all of these things are only done by decreasing the supply of money. Money is like any other commodity. If there's more of it, it's cheaper. If there's less of it, it becomes more expensive. And so, the piece I wrote back in, I believe it was in January or February, which was, stop worrying about interest rates and, shrink the balance sheet and let the market find its equilibrium level. I think the Fed is pushing hard on the market at the same time it's shrinking the balance sheet. And we went through this before. I mean, it's amazing how short people's memories are. In the fourth quarter of 2018, the Fed was raising rates and shrinking the balance sheet. And at the December meeting, the Chair Powell made the famous comment that, the balance sheet reduction was on autopilot. If anybody who was in the market remembers, we went down by 20%, and the next day the Fed was in the market pivoting and saying that the balance sheet mattered and the Fed reversed course in the first quarter.
But here's the thing about you, okay, because I posted this on Twitter, so people are saying, oh, the biggest bear in the world is coming on. You're a big guy, so you may be the biggest bear. You make these big calls, though. Bitcoin down 50%, which, by the way, it did.
Right.
It fell 50%. You're not going to be right 100% of the time. Why come out with the down 20%? Why?
Yeah, I wonder why.
Well, I mean, you obviously believe it. You're not saying, sure. You're not trying, you don't need Twitter followers. You don't need the headlines.
No, and you get the, look, you.
How much you guys overseeing now? 300 some billion?
300 billion.
Yeah, so you're not looking for more money.
No, well, it would be.
I mean,
nice.
Always, but yes.
Yeah.
But why make that call?
You know, the SCAR, well, you know, it's interesting because our clients and investors out there, you know, they get upset with me when I don't communicate to them. And so I try to find a happy middle ground where, you know, I write commentaries, but also where, you know, when I become aware of something and I don't have time to write a commentary, you know, I can get the word out quickly, and I have a lot of Twitter followers.
If you say stocks crashing 20% is a, quote, happy middle ground, I'm not sure I want to come to a party with you. Okay?
Well, you know,
Was there a worse ground?
Well, you know, I often tell people, don't ever hire an optimistic money manager. And I got a comment the other day. Somebody said to me, boy, Scott, nobody's ever going to question, you know, all the great investments you've made. And I looked at them and I said, you know, to be honest with you, most of our returns doesn't come from all the fantastic investments it's made. It's been avoiding the disasters. So we avoided you remember the financial crisis. You know, we avoided the drawdown that occurred in the pandemic. And, you know, that there's a time to, you know, to take some money off the table. I was very, very bullish in March of 2020. But, you know, right now, you know, I would say
money's been made.
Yeah.
Maybe those were some good years, right? After, I mean, if you bought near the bottoms, obviously it was from a market perspective. We had this boom off the bottom, and then we gained a little bit more. I mean, do you feel like we just kind of pulled forward future gains?
Exactly, and actually, I think we're giving some of it back. I mean, the real question...
We have to with multiples, right? Higher rates mean you've got to bring down multiples.
Right, and that was part of the reason I put out the tweet I did, that the multiple of the S&P relative to the historical multiples associated with these kinds of interest rates is way too high. And that's where the idea of a 20% correction comes from. But, you know, the other argument here is that earnings are going to improve. And I don't see where that's coming from. You know, look at FedEx last week.
That was a one-off, though. I mean, UPS didn't warn, DHL...
Right. No, but I'm just saying, you know, there are more and more negative surprises coming out. It's not just FedEx. And, you know, the energy, you know, when you look at the growth in earnings that we got and how earnings have held up, most of it has come out of energy.
That's right.
And now we're going to give it back. So
the least meaningful part of the 4.5% of the S&P 500 contributing an outsized. That's maybe one reason why a guy you know has been talking about energy for a couple of years. And what I worry about, Scott, is you look at there is a huge percentage of a big cap revenue of American companies that comes from Europe.
Right.
Europe's in big trouble.
In really big trouble.
And so is part of the thesis that EPS has to come down because global earnings, China's a disaster, shutting their economy down. Europe's got their own problems. You know what I mean? Want some water?
I haven't, thank you.
Okay, good.
But one thing that helped us with European earnings so far is the depreciation of the dollar. In the translation coming back, you know, the appreciation of the dollar.
Yeah.
So, I mean, eventually this is going to catch up, and this is all going to.
So how much more could we see earnings estimates come down? Because strategists on Wall Street, and they come on this show, they come on this network, we like them and we appreciate them. They do make changes mid-year all the time. Many have brought down their S&P 500 estimates already.
Right.
You expect then, if I'm hearing you right, some of these earnings estimates that are the basis for the multiple numbers and basis for the price targets, those have to come down.
Yeah, and I think, you know, look, 5% would be easy. 10% not to be unexpected. I mean, I would be surprised if it would be 20%. But, you know, the nature of the severity of the downturn in Europe is really bad. And despite what policymakers are saying over there, I think next year will be a really tough year for Europe economically.
It is. And they've got storage, which is great, but now they've got to exist just on storage, and you're going to see industries that have to slow down or shut down. We have got a lot more to do. You're going to be sort of co-piloting the whole hour with us. We're going to get you back in a few minutes, talk more about this idea, talk about some things you like, because everyone's like, he's such this bear. I mean, there are things that are not terrible. I won't say you love them, but they're not terrible.
Yeah,
that's it.
And I think there's a once in a generation opportunity right now.
That's a great tease. You should be in TV.
I am.
Don't say what it is. Once in a generation opportunity right now for the biggest bear on Wall Street. Scott, stick around, get some water. We'll be back.